Hello, everyone, and welcome to BFW 2401, Week 5, Part 2. Now, on this part, we will talk only about one issue, which is the target capital. It's 20 slides, and I hope it will not take a long time to do it. Maybe we'll do it efficiently, and I wish I can transfer the concept of this issue. Now, let me just share and start. So we are talking about this is part 2, and we are talking about selecting the target capital. We finished this in the first part, as you know. So what is the target capital actually? So in a bank capital planning, we actually trying to select a target capital level that is, which is one of the most important planning objectives. Now, to start a target, we have first to decide how much capital we should have. Now, this is, we assume a level of intrinsic risk, which we usually assume because we have all those risks as long as we are in business. And in banking, then we have all those type of risks, which we have explained it many times around the 10 risks. Now, that 10 risks, this is the concept. Those risks will be mitigated by the management control. And then what is left is what is supposed to be the capital. So next step is that capital what we want, or are we willing? So that actually capital is telling me this is the risk that can be spill over from the intrinsic risk mitigated by the management. The spillover is actually the risk that cannot be kept by the management, and therefore I should have some buffer enough to cover that spillover. This is the concept. But sometimes, if my objective is to maximize the shareholders' wealth, I can still increase my risk as long as the impact, as long as it will give me more return, and the impact on the shareholders' wealth will be increased. So just, I think I have shown you this graph before. Look, maybe econometrics people know, and I think everybody know if you have taken the first, this is just a distribution. Distribution of what? Of losses, of the losses that are coming from the risk. Now we have risk, credit risk, market risk, whatever, and even inside each risk, different risks. For example, in credit risk, are you talking about credit card? Are you talking about business loans? Are you talking about housing loans? All of those will be, for example, I will take the observations of the last 10 years and then put it here. I will put it all here, and I will build this distribution. Now, I'm talking now about one risk, but what's happening actually in life is they take all the risk, they make some type of simulation, which means they increase the number of the observations, and then they take the marginal risk. So you have the market, the liquidity, all of this, they will make what we call marginal distribution and build this one. So now this one, for example, this will be the area which I can, this brown area or orange area, is the area where I can control by management. Now, if I can control this by management, whatever after that, then it should be my capital. This is how we decide the capital that I should have. So this area is actually the green area, is the capital which I have with, say, 99% confidence that the losses will not exceed this area. Now, you are not responsible to explain all of this. I'm just giving this graph to bring you with me in this story. If we know this, then we move to the next step. So the capital planning problem is to achieve a target capital position, which together with the given level of inherent risk and management and control will generate an optimal risk return position. So what is the optimal risk return position? It is the position where it maximizes the shareholders' wealth, and I think we have talked about this. I can take risk as much as I can, as long as there will be more return, and end of the day, this mix, which I call it trade-off, will increase the shareholders' wealth. Now, let's talk about this area, which is if you are giving a loan of, say, for a business loan for one of those big companies, and it is, say, 100 million ringgit. Now, this 100 million ringgit, you choose. The decision is either to increase quality capital. How much you bet depends on what capital you are deciding on, how much you will finance it from your capital, and how much you will finance it from debt, which is from the depositors' money, from interbank, lending, from other sources, from issuing bonds and getting this money, commercial papers, whatever, any debt. Think about any debt you can take as a bank to finance your assets. So how I can reach to this position, how much I should put here? Is it 10%? Is it 15? Is it 20% of capital and the rest is debt? Now, this will be impacted by 3 issues. Now, this is the 3 issues. Somebody would say it is 4. No, it's 3. So we are considering the tax deduction and the regulatory compliance. Let's agree, first of all, in this. And then we have the capital risk and the market discipline. Now, capital risk and market discipline has this causality position where actually the capital risk will lead to market discipline. So as I will explain it now, so the market discipline is actually the concern of considering the risk to the stockholders. Now, let me show you now the tax deduction. I think should be very clear. These 3 issues or 4 issues. There are 3 factors, but 4 issues are actually the one that will work with us in deciding our target capital. Now, tax deduction should be clear because if I am going to take a capital, if I'm going to finance the loan from debt, it's very useful for me. I mean, as a bank. Why? Because first, the debt is cheaper. This is a fact of life. Debt is cheaper than equity. When we take shareholders and we raise funds in shareholders, the usual return on equity in the market 15 to 20%, because these people will buy your shares and they will be investors with you. I mean, as owners, as shareholders, and they are subject to dividends policies, subject to losses, subject to all those things. So in this case, they increase the return, say 15 to 20%. But then when you take debt, you can reach to 4 or 5, 6%. For example, if you issue bonds and the coupon is 6%, which means it can be very attractive for some investors because they can actually guarantee their money. This is the first thing. So it's cheaper. Fine. The second thing also, when I pay the interest for those debt holders, which is the people who buy my bonds, I will deduct that interest paid from the net income, from the tax. So when I come to the tax, the taxable income will be less because I already deducted the interest paid to the bondholders. So now I have a tax benefit that will increase my cash flow. So taking debt will give me 2 advantages. One, it's cheaper. Second one, it's tax deductible. So therefore, if you are thinking from this perspective, which is the tax benefit, you will say, I want to minimize the capital as much as I can. It's very beneficial for me to take more and more debt and leverage more and more because that will increase the bottom line. Let's start with this. So this argument for loss capital. Let's come to the next argument, which is actually the capital risk. So lower level of equity capital means higher risk in 2 ways. First, there will be small caution to absorb unexpected losses. The other one is more volatile earnings. What do I mean by those two issues? I think the first issue in A, you already understand it, because if you don't have enough capital and the unexpected losses is higher than the capital, then you are gone, as we talked here. If this area, the green area is 8%, and actually you achieved, say, 12% of losses, 2% may be covered here by the provisions, and 8% by the capital, still 2%, you are gone. So if the unexpected losses is 12%, you are bankrupt. So this is the first issue which we should agree upon. Now, the second issue is more volatile earnings. Look, if I am leveraging, if my leverage is very high, say talk about 95 and 96% of my total assets. So which means in this case, I'm paying interest for my debt holders. And this interest most of the time could be volatile. So in this case, if there is changes in the interest rate in the market and affected the interest rate I'm paying to the debt holders, especially when we talk about money market, or you talked about volatile bonds that is connected to labor, which is this rate that keep changing. So in this case, so which means for the same level of debt, sometimes I will pay more, sometimes I will pay less, sometimes I will pay more or less. Look at this zigzagging. Now this zigzag is creating something like volatility. And therefore the bottom line, the net income will be increased and decreased according to the level of the interest rate paid to the debt holders, which means now my bottom line is not actually affected by my operations. It's affected by the interest rate. And this zigzagging, which we call it volatility, is not a good thing for the share price. It represents some type of risk. So this is two issues now. So if you look at this issue and you concern about the capital risk, you would say, you know what? Forget it, I want more capital. So if you are thinking, again, if you are thinking from a capital risk perspective, you will be arguing and you will be favoring more capital, unlike the tax deduction, which we talked about it in the first slide. Let's talk about the market discipline. Now, the market discipline is actually connected to the capital risk. So if there is a capital risk, now we will have two people, we will have two parties, one or two stakeholders. One of them is the depositors and the other one is the investors. So when they say these changes and they say they see you very highly leveraged, and there is a volatility also in your income, they perceive you more risk, and therefore they will increase the return, which means they will ask more. So investors, instead of taking your bond for 6%, now they want 8%, 9%, and depositors, maybe they ask for more. So in this case, this is where the capital risk actually affecting the market discipline, and this market discipline will increase your cost of capital. As I told you, they perceive you more risky, they will ask for more return, so your cost of fund will be higher. So if you are in this situation, you would say, you know what, I want more capital. Because if you are arguing from the market discipline issue, which is connected to the capital risk, you will say, I want more capital. So this is the third issue. Now, one issue is favoring less capital, and now two issues until now are favoring more capital. Now, before I move from this area, I want to tell you something. This issue of market discipline sometimes, and in the model that we will discuss later on, is actually ignored. Why ignored? because they say most of the depositors, like me and you, we call them unsophisticated or naive investors. We don't know, we don't care. And when I put my money in Maybank or RHB or HSBC, I don't go and look to their capital, and so I just follow follow the crowd, as they say. So in this case, actually, it's not the market discipline is not working with me as an unsophisticated investor. The other thing, the informed investors, which actually they are the big investors, they think, and sometimes they are right, that banks are actually guaranteed by the government and they are not going to collapse. There is, bailouts, there is, too big to fail, and all these issues, and therefore they're actually not worried about the capital. So overall, if you look at this issue, and for the purpose of the model we are going to develop, the argument of market discipline and capital risk is ignored. So in this case, let's move to the next step, which is the regulatory compliance. Now, we have to be friends with this party. And when we say we have to be friends with this party, we have to comply. And we have talked about compliance for so many times, which means complying with the rules, carrying out all the orders coming from there and directions, and then applying their standards. So actually, they ask for us for minimum level of capital, and if we don't do that, for example, if the bank argue about the directions from the central bank or from the supervisors, they can do so many things. One of the things, they will prevent you from lending to certain areas. They will decrease your exposure, and if you continue doing that, they can shut down the bank. It's just like this, and they can take over and restructure and do so many things. So even when I have less capital and the regulators are not happy with that, they will start to penalize me. This and this. So as you can see, there is a cost now, so many costs for the regulators if we don't comply. Overall, I give you this chart. Now, this is just to summarize what we said. So we have one, which is the tax. Number two is the financial risk and the credit risk. And number three is the market discipline and regulatory compliance. And we have explained this, and this is the logic. So this call for less capital, and the three of them are calling for more capital based on the argument I just explained in the three slides. Now, having said that, we are left actually with two factors out of the four factors, out of the 4 points which we talked, that is coming under the three factors, which means now I don't have, I only work with tax deduction and regulatory compliance. I already, forget both of those items. Having said that, if I'm left with tax effect and regulatory capital, as you say, capital risk and market discipline already omitted. So in this case, I can develop my model. So my model is saying the value of the bank is the value of the bank with both equity and debt funding. And now value of the bank, a view is actually the value of the bank with no debt, and the tax deduction is the value of the tax deduction on interest rate, and C is the regulatory capital, and T is the tax rate. So if you can see, so this is the value of the bank, which is the original value, plus the tax deduction minus the cost of capital, cost of compliance. And I have talked about this so many times, including in last week lecture and even workshop. So in this case, actually, we are not talking about this. This is only expressing the return. But we are talking about actually this graph, which actually showing me the function of this area, which is the value of the bank plus the tax deduction minus the cost. And I think I have explained this so many times. It's very, so we are not talking about this linear equation, but this quadratic. Now, having said that, we come to the sorry, issue of the trade-off. Now, the trade-off meaning is to increase return as much as as we said before, as much as the increase in return on risk actually, well, which means taking more debt down, which give me more tax deduction, as long as the increase here will continue. So this is the optimum area where I can reach the optimum one. Now, if I show you this one, so I want you to understand the trade-off from this perspective. If I show you this one, and I told you based on my simulation, I found many areas here. I can be in this here or here or here, but I know it's in C. So if according to my numbers and simulation and distributions, I reach to this area to be 85, which means if this is the debt, I have to have 85 debt, which give me an optimal position. If you know this, now I can ask you very easy. So how much capital I should have? You will tell me you should have 15%, because it's the difference between out of each dollar I finance is 85% or 85 cents will come from the debitors, and of course the rest will come from the capital. So my optimal capital according to this calculation is 15%. Now, I think this is the most technical point. Let's come now to see other factors that will affect our selection of the target capital, which is the rating agencies. Of course, the rating agencies' responses is very important because they will rate us, and those people actually look for more capital. The second thing, we have also to look at the future and explore and contemplate the future and see whether we should have that capacity and flexibility. So assuming now I'm already 98% leveraging, and in the future, something happened with my liquidity, something happened with new opportunities in the market, I want to borrow more, borrow where? You are already 98% leveraging, there is no much room. But if you are actually 85% or 80% and the rest is capital, at least you can increase the debt to 85 to 90 when there is contingent or contingencies or urgent issues to raise capital in the future. Even when you do mergers and acquisitions and all these issues, you have to have some type, because we usually borrow and acquire. So actually, if we have some acquisition plans, also we have to have more capital. So rating agencies asking, arguing for more capital, debt capacity arguing for more capital, future acquisitions argue for more capital. We have one issue which argue for less capital, which is the corporate control. Now, the corporate control is under consideration. If the management of the company actually, or the bank is actually trying to take over the bank, which means in this case, they will take more and more and more debt, leverage more and more and more, until you reach to a point where the shareholders, because you take debt and you buy, you do payback, which means you buy the stocks, your stocks from the market. So the situation of decreasing the shareholders and the capital continues with the increase of more debt. Or you can finance more assets by only debt, and so the percentage or the proportion of debt to equity keep increasing until those equity owners becomes just a minority. And in this case, you can management and the debitors can team up and actually control the bank or the company. So this argument, if it is in mind, more capital, less capital is the best strategy if you are trying to do corporate control. Now, there is one more issue, which is availability and cost of funds. And this is another issue and other perspective when you think about it. So if my share price is very, very high now, and it's overpriced, it's time to issue capital and increase capital because your share price is very high. So this is what we call the availability and cost of funds. The other thing is if the interest rate in the market is so low, and you can actually finance debt by borrowing with this cheap price. So this is the best time to increase the debt. So it's different perspective. You have higher share price, it's time to issue capital, or you have very low interest rate in the market. It becomes very tempting for you to finance through debt because it's very cheap credit now. Now, we have also to look at the end to political and regulatory and economic environments. So here, you cannot just say which one you are arguing for. It depends on the availability and cost of funds. And this, as I told you, it's the corporate control is calling for less capital. Having said that, I brought also these issues for you. So we have the rating, we have the debt capacity control, regulatory, future plans, availability, and cost of funds. With this, I finish actually this part, and I will see you in the third part. Thank you very much, and see you in the third part.